strategy I'm going to explain to you ultimately is very simple, but simple is not easy, right? Like, it's simple to get in shape. You have to eat well, exercise, sleep well, but it's hard to do these things in practice, right? And so volatility selling is a simple trading strategy, but it's kind of like you have to have discipline and you have to have faith in that the numbers will ultimately surface in your favor. So that's why it's simple but not easy. This talk is also all about the intuition behind option selling, not about mathematics. You know, option selling, trading in general, you need to sort of think about it as a service that you're providing to the market. If we were to start a cleaning business, we wouldn't first get a doctorate in chemistry to figure out what's in the products, right? We would just pick up a broom. We have to know that we have to add water to soap, and then we can start actually just doing the work. And I think options are very similar, right? You don't have to know the mathematics. You have to know how these instruments, how you can use them and what the psychology is behind it, but you don't have to focus on the mathematics. All right, let's go to the next slide. Oh, excellent. Whoops. So first, I always want to start though with explaining why options exist. It's actually a real solution to a real problem. So they grew out of futures trading, to be more precise. And futures trading really emerged in the Middle Ages when shipping technology took off. And ships could sail around the world, and so this opened up this global trade. But it also created like all sorts of new problems, right? Like you have this working capital sitting on a boat. So if you're the seller of that good, that's a lot of working capital that's tied up. So it's natural that you want to be able to secure the sale price before the goods arrive in the docks. And from the buyer side, similarly, it could be nice to lock in the price so you're not exposed to a later increase. But actually, as a buyer, it's not like an ideal solution because you're only asymmetrically sensitive to price. If price would drop, you'd be happy to buy a spot later. You might want to check the quality. It's also hard if you have to forecast how much you exactly need in the future. And so for all these reasons, actually, this custom started to grow where the buyers of futures started to offer a premium on top of the future price to the sellers to have the right to not take delivery, right? To have the option to choose. And so as it turns out, that options to choose is kind of valuable and sort of really changes the nature of the contract. Because when you have the right to choose, you basically choose what's best for you, right? And what happens then is that this sort of payoff structure of a future, which is symmetrical, it becomes asymmetrical because basically the buyer will choose not to exercise when the price is unfavorable, and he will only exercise when he can lock in a profit. And so you get, like, with an option, you get this hockey stick payoff, this asymmetric payoff. And when you then reason through the consequences of having an asymmetric payoff, then you start to understand that you want extreme events, you want volatility actually, because if price really goes up and you've bought a call option, you're very happy, you had a convex return. If price drops a lot, you could have lost a lot more by owning the underlying, so you're happy as well. And so the extreme scenarios are actually very beneficial when you own an option. And so this is how, from the history through the practical application, it becomes clear why options and volatility trading are sort of synonymous, right? It's sort of baked into the structure of the payoffs that options become basically a question of trading volatility. Now, if we want to get an intuition of how to price that thing, then we can first start to look at like a binary option. It's kind of intuitive. A simple bet is, for instance, that Bitcoin will pay $1 if it exceeds 80K at a certain time in the future. Well, it's pretty intuitive to sort of figure out what goes into the pricing of that bet, right? What would you be willing to pay? Well, first of all, it depends on where the price currently is relative to that strike. It depends on how much time you have. And then obviously, naturally, it depends on volatility, right? How much is Bitcoin actually moving each day? And those three inputs will define your willingness to pay. It will actually, in the case of a binary option, it will express sort of a probability, right? You'll pay somewhere between 0 and 1. And how much is then a function of volatility, time, and distance. And so you can think about that more intuitively in the language of movement, right? The distance to the strike is the distance that you need to travel, the kinetic energy that you need. And volatility and time basically defines the potential for movement that you have. And so the natural language of options is very important. Like it's basically just expected movement. If you then think about what a call option is, well, a binary pays $1 if you go past the strike. A regular call option is sort of like this infinite set of binaries. It pays $1 for every dollar that you go past the strike. And so where the binary was pricing a probability, now the call option is basically pricing the magnitude of a move. So the building blocks of like the inputs to the pricing are very similar, but the way you think about trading them is a little bit different. With a binary, right, once the price is in the money, you basically want price to stop moving, you become short volatility. Whereas with a call option, if you buy it, you're always long volatility, right? Because even in the money, more volatility means a bigger potential increase of your payoff. And so you're always wanting more. Now, if we think about trading volatility, we could do it with calls and puts. But those are directional volatility bet, right? Calls betting on upside and puts betting on downside. So if we want to bet on movement in both ways, we simply combine a call and a put and then we get a straddle. Now a straddle is sort of the most desirable payoff you can draw in all of finance, right? Because it's literally a hockey stick on two sides. So the payoff itself, unless the unlikely case happens that the price expires exactly at the strike, the payoff is always positive. As Thalex likes to describe it, it's buying at the same time drought insurance and flood insurance, right? Rain or sunshine, you're always going to make money if you're long a straddle, at least on the payoff side. Now, the question then becomes, do you always want to be long a straddle? And the answer is actually no, because it all depends on what is the cost of actually securing that payoff, right? The payoff of a straddle is a very desirable thing, but somebody needs to be willing to sell it. Those are market makers usually, and they need to be able to make some kind of profit margin on top of it. And so the issue with being long straddles, being long volatility in general, is that we're not precisely betting on a move as much as we're betting on expected movement relative to what's already priced in. And so with a straddle, I think the most intuitive way to visualize what's priced in is just to add the price of it to the current spot price of, for instance, Bitcoin. And then you can look at the range, the box that it draws, to then figure out whether you think by the end of the expiration window, will we be inside or outside the box? That's basically the question. Inside the box, the sellers win. Outside of the box, the buyers win. By the way, if you ever do technical analysis, I would advise you to not do it, and if you have option prices, just use that. It usually draws a nicer range than you can sort of subjectively. But basically, the issue is now, when we buy straddles systematically, aren't we just always overpaying for volatility? So it turns out that is the case. When we actually look at prices of options over time, it turns out it's a little bit easier to express them as a volatility number. It's basically taking the price and inverting the formula to sort of figure out what's the volatility input that would correspond to the price. Now the nice thing with expressing prices volatility is that we can compare them over time. And in the case here of our straddle, we can actually compare the volatility that you had to pay for compared to the volatility that would actually realize, right? So that's the chart here. As you can see, blue line is implied volatility from option prices, white line is realized volatility. So it turns out that like most of the time, this implied volatility is too rich, right? It overestimates future expected movement. Around 2/3 of the time, the people that sell volatility actually win. So now we're getting actually more interested, I guess, in the business of selling options. And then obviously I have to give you the warning sign. When you're selling options, when you're selling straddle, selling movement, you're selling asymmetrical risks, right? They call it left skew in a technical term. It basically means your P&L is like that frequently you win, but sometimes you lose. And when you lose, you can lose a lot more than your average win. This is, for instance, like the volatility surface on there, but when October 10th happened last year. You're not having a good day if you're selling a straddle at 40 vol and then it explodes to 90 to 100 in a day, right? And so these large losses is what we have to deal with when we're selling vol. And the reality of it is, it's not really a way to outsmart these events from happening. I mean, it would be a little bit similar as saying that you can predict black swans. It's kind of impossible. The only way we can manage this is by actually selling volatility systematically so that we make enough bets, make enough money in the normal times that we can stomach the drawdowns when these bad events happen. And this unpredictability, there's a lot of people that try to get clever when you're doing trading, and being systematic is a lot more important than being clever. You can sort of philosophically arrive at that conclusion simply by thinking through the fact that prices at any given point in time, they are a reflection of expectations. And there's always like a finite set of things that really matter for a price. So there's a finite set of things that go into the expectations. There's always an infinite amount of ways you can be surprised, right? So it's always likely that something unlikely happens, just because the magnitude of what would be unlikely is always larger of the few things that are expected, that are consensus. This is actually structurally not really a way to predict the unpredictable. We deal with it by just being systematic and by trying to make enough money in the normal times that we can sustain the... All right, so now we're getting a little bit closer to defining our volatility selling strategy. I first have to show you theta, which is the time decay of options. And that's the other side, the beautiful side of selling options, is that every day where time just goes by, we make money. It goes back to that idea that I explained of like a binary option being priced based on volatility and time, based on expected movement. Well, every day time goes by, the expected movement that can happen until expiration shrinks, right? The possibility space shrinks. And so the value that people are willing to pay for the option, both practically and theoretically, it goes down. Now, because we are in the business here of selling volatility, we want to sell as much of it as possible. So what we're going to do is we're going to do at the money. We're going to sell straddles basically, which are at the money options. That's where the time decay is the most intense. It's also where the optionality is the highest. That's the middle area of the chart. You could also sell out of the money options. In the money options would be very exotic. But with out of the money options, it's sort of more of a mixed bet. Like if you're selling straddles, you're just selling volatility. You're selling a forecast of future realized. If you start to sell out of the money options, it becomes more complex, right? Because it becomes more driven also by the probability of even getting to the strike, and then how also volatility will change in function of price. It becomes also about the correlation between price and vol. It becomes also about like vol-of-vol, about tail risks. So that's actually a lot more complex already, and it's also hard to get feedback from those systems. So I personally prefer just, if you're selling volatility, just sell at the money, sell straddles where there's most of it, and where you get most of that time decay in your favor. The other thing to mention is that we want to sell actually short-dated options. And because we want to run a system here, we want to have enough reps in our system. And so selling weekly is better for that. We could sell daily options as well, but then it starts to become, we start to execute 7 times as many trades. Liquidity conditions on daily options is also a little bit harder. So I feel like weekly options here is a better compromise. And then also the nice thing is that this variance risk premium, this tendency for implied vol to be higher than future realized, turns out that it's also a little bit higher, relatively speaking, for short-dated options. So from all these directions, right, when we're selling vol systematically, we actually like the idea of looking at shorter-dated options. So then we're sort of ready to start our backtest, right? Just a few notes on the data I'll show. We took about a year worth of Bitcoin data. We're selling a 7 days to expiration straddle each Friday at 8 a.m. That turns out also to be the time where these things expire and introduce. So we basically always let an old straddle expire, and then we sell a new one each week. The backtest is May 20 to May 2026. And we're also always investing like a constant notional size into the each week. And so as you can see, like this has been a pretty volatile price range. I mean, for Ethereum, obviously, it would have been similar. But you had your all-time highs. You had like then a massive downtrend. You had also the colorings in function of volatility, a lot of volatility spikes along the way. So I guess now it's time to see what is actually the result of selling volatility each week. And so it turns out that we're actually up. We made good money. We were up 30K, which on our notional is a 30% CAGR, which on the actual margin requirement of is even better. It's more return on margin. Now in reality, you would have to leave a bit of margin balance so I'd say basically ROI realistically is somewhere right between 30 and 75. Let's call it 50. Now the problem, of course, you can see immediately though, is that it's extremely volatile. We didn't really just make 30K in a year. We made 30K 2 times, and we also lost it. Especially the period first starting with October 25th, we lost a lot, and then especially in January, we had this massive drawdown, which is when sort of these correlations with threats started to break. So worst week here is like 70K down. It's a very, very volatile ride, and that's why I'm also saying like it's to capture edge when you have a lot of volatility, because it's an undesirable profile, and you have to then have the discipline to stick through it, right? You have to have the discipline to potentially lose most of your returns and then keep going, because that's where the most profitable few months of volatility selling were just opening up. So if we then plot like the weeks in a histogram, we see all the things that I sort of explained until this point, right? You see that our win rate is 2/3, 70%. Most of the time we're winning, but you can also see that like the upside when we win is smaller than the drawdowns lose. And so what we've done here is we've been selling straddles, and we've been actually exposing ourselves to directional risk. And this is something where you have to take into account with options, is that your positioning, your profile to the market, it actually changes over time. So when you sell a straddle, it's sort of delta neutral, as we like to call it. It's sort of, it has this exposure, but then once price starts to move up or down, it actually starts to, the straddle actually turns into more of a dominant call position than a put position. And so at that point, you do start to have like more of an upside or a downside bias in your exposure. And so when the market starts to move, the straddle becomes increasingly actually no longer a volatility position, it becomes a directional position. Now it turns out that that is part of the problem of why these big directional moves happen against us, right? Like basically the big drawdowns came in this downtrending market. It just came when we were short a put, and then just the market went down 20, 30K. So then the question is, can we do better, right? Like, can we avoid that upside, but avoid the massive drawdowns? And actually, this chart, I just noticed that this is the wrong chart. But if we do the right chart, what we would actually see is that it's the P&L that we would have made from hedging. The short straddle position would be the same, would be 30K. But the drawdowns would be a lot lower. The worst drawdown was only 6. And so this is actually the process of hedging just once a day. Like we basically look at what kind of like exposure we have, what kind of directional exposure we have to the underlying, and once a day we trade a perpetual to flatten that. And so left side you see the raw P&L, right side you see the hedge P&L, and then on the right side you see the total P&L. So what hedging does is it takes the directional risk out of our volatility trade. And it does kind of what you expect, right? It smooths out the P&L. It makes the losses the worst, but it also costs you a little bit of upside. And so the reason why that is because, I think again, like a straddle is sort of short movement. Let's say the price moves a little bit. Now we are like slightly short the underlying. And so what it will do is it will buy perps. So we start to buy perps on the way up. And similarly, on the way down, we're sort of selling perps. So we're always, like with our hedge, we're trend following. And so if then the market doesn't end up breaking out, but just like moving in a range, what tends to happen is that we buy on the way up and we sell on the way down. So we have this, hedging is sort of costly because we're, in a mean reverting market, we're sort of buying high, selling low. We're doing the opposite of as it's called. But the good thing is that sometimes then when the big breakout happens, like in January, the market just loses the floor, and this hedging algorithm starts selling perps and making most of the loss back. So I would say that like if we do the delta hedging, it actually becomes like a slightly easier system to maintain. Just the P&L swings are less extreme. And that's basically all you need to know, right? Like the strategy is just about like selling a straddle each Friday, and then once you are getting into the habit of that, I would say the performance of the short straddle is already pretty good. Like once you get into this habit, you could look at all these ways in which you refine the strategy. So one thing you can do is you can start looking at different strikes. One that I think is very interesting is you can start looking at seasonalities. For instance, volatility has very different behaviors throughout the week. So in the weekends, for instance, volatility tends to be structurally lower. Most of the volatility actually happens each week in only a few hours, which is these days around the US Open. Around the US Open, actually the volatility is almost twice as high as the normal. And so then you start thinking about like these systems that they get a little bit smart about like maybe having less exposure around the US Open and then adding back more once that volatility window is down. Similarly with events, right? You could have a calendar, you could see macroeconomic events, FOMC, there's more chance of volatility. So you can start like selling options, but then sometimes like filtering out like when you have an exposure on to improve return. And then from there, you can start looking at just like other tactical choices. Like, sometimes, you'd be better off selling a monthly straddle and holding that for a week rather than the 7-day straddle, because sometimes the 7-day straddle is more expensive in volatility terms. You can start thinking about like refining your hedging strategy. And you can even think about like selling straddles, but then like buying crash options, buying out-of-the-money puts or calls to sort of remove the tail exposures. That could be an alternative to delta hedging. So there's a lot of stuff you can get into once you basics, right? But I would say that the selling volatility systematically, just every Friday logging in and selling a straddle, that alone is actually already pretty effective, right? And the problem with trying to make a system better is that you can sometimes make it worse. Trying to make a system better with like more parameters, more choices, more little things you add, they also sometimes worsen the feedback loop that you get. So in general, like you try to reduce complexity, but yeah, it's in and of itself, right? Is you have the edge, you have the edge, and so by trading systematically, you should be able to capture it. That's the most important thing. So where can you then sell straddles? Well, you can on Thalex, for instance, we have a builder where you can execute these trades in one go without having to do individual options trades. We also offer the delta hedging via bots in our user interface, so you can instead of having to write your own delta hedging logic, which would be quite complex, you can basically just click a few buttons on our UI and let Thalex take care of that. But so basically this idea of like delta hedging a straddle each week is literally just logging in each week and activating these systems. So then to recap it, it's the language options is ultimately about the movement, right? That's the intuition behind it. That's much more important than the mathematics. Ultimately, option prices are all driven by volatility and time. Optionality, right? The possibility for the underlying to move has time value, which also means time decay. When we're selling options, that's what we're capturing. Why selling options works is because the implied volatility, right? The prices that we get for selling options are usually higher than the actual movement that subsequently realizes. We can capture that edge by selling straddles systematically, and then, as I mentioned, we will have drawdowns. We cannot market, we cannot predict the unpredictable, which is why it's very important to just do it systematically and keep doing it so that the edge, so you have enough reps in your system and that the edge can turn in your favor. If we then add the delta hedging layer, I would say that it is desirable. We focus more on then purely selling volatility. We take the directional component more out of it, and we will smooth some of the big drawdowns. And so all these things in combined, it's selling volatility in my mind is sort of effective. It's sort of the service that you can provide to the market. I think a lot of people, when they start trading, they kind of look for things to predict. They look for, either through technical analysis, now increasingly machine learning, they try to sort of think of like these clever predictive systems. And really what you can do in markets, you just need to think about like, what's the service I can provide? And usually it comes down to, you know, selling volatility or market making or essentially being some kind of like tail risk that other people don't want to take, and that's why you get compensated with some form of yield. And so volatility selling from that perspective is unreasonably effective. It's one of those edges that keeps giving, right? Like funding rates, for instance, at some point they've gotten completely compressed, whereas like variance risk premium, as you could see, like we're talking still about like 30% annualized returns. And that's something that that is going to persist also in crypto for the foreseeable future. So it is incredibly effective, but you got to handle the P&L volatility, and you got to stick to the system. You have to have faith in the numbers ultimately. That's it. Any questions? Yeah?
You mentioned on the hedging process, you had zero latency, and I wondered how.
Oh, okay. Yeah, so the nice thing that we did at Thalex is we built in the hedging bots actually in our matching engine, so that the triggers for the hedging orders to execute, they happen fully internalized in our system. Like there's no latency from orders that have to come via an API. No, the nicest thing about like delta hedging, having that built into the exchange, is just that if if I otherwise want a delta hedge, I have to code up the API connection. I got to run it through AWS. You know, probably in my first versioning of it, there's going to be some bugs. So it's not like a super hard system to build, but you know, just anything that's algorithmic trading is hard on its own, right? Because you have to deal with also all the things that could happen as well. Of like, for instance, what happens if for a minute there the spreads in the perpetual order book are like quite wide. Like our system also has all these protections built in that it doesn't trade with too much slippage, and it will sort of retry the order as soon as the liquidity is back. And so yeah, I would say that is the big advantage of sort of also kind of why this strategy works, is because volatility selling, it's a simple idea, but if you want to do it, you have to handle the volatility, and if you want a delta hedge, you have to be able to build all these systems, right? And so what we can provide is actually a platform that does a lot more than our competitors on that level, but you're still trading sort of similar prices, right? So the edge is the same, but you get better tools to get the job done.
Have you ever tried applying this system to cross-pair trading, for example?
To cross-pair trading?
Yes, like BTC USDT on one side and Ethereum on the other, or something like that.
Yeah, so it's definitely possible to do that. So what could be a very interesting way to trade, I don't know, ETH BTC, let's say we expect that it finally goes up, is we could short a perp on Bitcoin and we buy ETH calls. And then it becomes more of a convex pair trade. And it's the same underlying exposure, right? Pair trading is about like correlation trades. And what's really nice about doing that with options is that like the problem with correlation trading is that it's usually sort of very persistent, and then it can flip around, right? I mean, a good example now is like maybe Hyperliquid and Lighter. Lighter's been trending down versus Hyperliquid since forever. At some point, there's going to be a catch-up trade. So that correlation can just completely shift. And so when you then have an option in the mix rather than sort of an exposure of two perps, you can make that more of an option on the correlation rather than the pure correlation itself that you would get with the pair trade on perps.
Do you also observe leader and lag effect like you see in perpetuals, where in many cases you got like Bitcoin leading an uptrend and then ETH and SOL following afterwards?
Yeah, I mean the vols are very correlated, but the vols are also structurally different. I guess the vols are The option prices are very correlated because prices between Bitcoin and ETH on any sort of short time frame are still like really correlated. But the vols of like ETH and Bitcoin are structurally different. So Bitcoin vol currently is like 30s, 40s. ETH is now like 50s, 60s. So ETH is structurally higher. Hyperliquid vol is maybe now like 80, 90. It was apparently 75% yesterday, but then it was testing the all-time high, and then that changed a lot. So trading these instruments, trading these options like feels very different because the vols are structurally different. But I would say the trend that I just showed for Bitcoin is going to be very similar for ETH. The edge, the relative variance risk premium, all these things are very similar. But yeah, if you have a higher vol asset like ETH, it's going to also come with like higher drawdowns.
Thank you.
Any other question? No? Then I think another big round of applause for our guest, Hendrik.